The United States has proposed tariffs of 10 to 12.5% on 60 economies, including the UK and the EU, citing forced labor. This signals that the fundamental logic of global supply chains is being completely rewritten. Your business and assets must reassess their globalization strategy. This is geopolitics and economy. This video reflects only personal views and does not constitute investment advice. Market risk exists. Invest with caution. First key issue: the shifting foundation of trade war tools and the weaponization of compliance. Markets generally believe U.S. tariffs on China are based on national security or overcapacity. But the latest signal shows the U.S. Trade Representative, or USTR, is launching a new round of trade investigations against 60 economies under the pretext of forced labor, proposing tariffs of 10 to 12.5%. Among them, China, India, and Vietnam face 12.5%, while the EU, UK, and Canada face 10%. So what does this mean? In fact, this is a carefully crafted alternative trade weapon after the Supreme Court overturned broad tariff rulings. It repackages trade barriers from easily debunked national security into hard-to-refute human rights and labor compliance, bypassing traditional judicial review. In other words, America's underlying demand has shifted from a pure U.S.-China decoupling to a forced redistribution of global manufacturing profits. This indiscriminate strike locks out low-level pathways for Chinese firms relying on physical assembly relocation or nearshoring to whitewash origin. Going forward, the driver of China's macro exports must shift from physical factory relocation to deep capital outflow, localized supply chain nesting, and the export of foundational technical standards. Second key issue: the geopolitical risk premium in the Persian Gulf is being permanently priced in crude oil. Markets once believed Middle East conflicts were manageable friction, but that myth is now shattered. Iran, for the first time, abandoned its proxy model and directly used state-level firepower, launching missile and drone attacks on Kuwait International Airport, killing 1 and wounding 63, with all flights grounded. It also targeted the U.S. Fifth Fleet stationed in Bahrain. In response, the U.S. military struck Iran's military control station on Qeshm Island. In my view, this is the most destructive geopolitical black swan event this episode. Iran's move has crossed the red line of war, marking the Persian Gulf conflict's official escalation from manageable friction to national-level hot war. The severe damage to Kuwait Airport not only paralyzed regional air logistics, but also destroyed the traditional Middle East security framework, signaling limitless future retaliation. As a result, Brent crude surged 1.9%, approaching $98 a barrel. War insurance premiums for the Strait of Hormuz, a choke point for 1/5 of global oil shipments, will spike vertically, possibly triggering a mass refusal by ship owners to transit. The real physical supply disruption risk has completely replaced the prior macro demand weakness expectation, becoming the absolute core pricing factor for commodities and inflation. Oil surpassing $100 a barrel is now nearly inevitable in the short term. Third key issue: early confirmation of macro liquidity drought and divergence in risk assets. The U.S. May ISM Services Price Index surged to 71.3, a multi-year high, with new orders at 57.3, significantly beating expectations. Strong ADP employment data and JOLTS job openings confirm the U.S. economy's resilience. So what does this mean? In fact, extreme stickiness in services inflation has completely shattered Wall Street's hopes for a near-term Fed rate cut cycle. The Business Activity Index at 57.7 indicates domestic demand remains overheated. After the data, the 10-year Treasury yield jumped 4 basis points to 4.5%. A prolonged high-rate environment will exert devastating suction on non-U.S. currencies globally, while sharply raising capital costs for U.S. firms financing AI data center construction through debt. This could be the macro trigger that pops overvalued tech stocks. Tightening macro liquidity is accelerating transmission to high-risk assets. Spot Bitcoin ETFs recorded the largest weekly outflow of the year, reaching $1.67 billion. The S&P 500 also ended a 10-day winning streak, with only 17% of components outperforming the index. This shows extremely narrow market breadth, risking a stampede sell-off in passive index funds. Balance sheet repair for non-U.S. nations will be forced into an indefinite delay. Fourth key issue: Russia's stagflation abyss and Ukraine's deep strike capability. Markets once underestimated Ukraine's deep strike ability. But the latest signal shows Ukrainian drones crossed over 1,000 kilometers of defense lines, precisely destroying an oil export terminal in Russia's second city, St. Petersburg, hitting a missile frigate at the Kronstadt Naval Base and military-industrial facilities in Tambov. During the attack, President Putin was preparing to attend the St. Petersburg International Economic Forum, with black smoke over the city and the airport briefly closed. In my view, this was a deeply humiliating and tactically significant deep strike. It not only disrupted Russia's flagship economic forum, known as the Russian Davos, but more critically, exposed the gaping air defense hole in the country's core energy export hub and naval base after most air defense assets were concentrated on Moscow and the front line. This forces the Kremlin into a painful choice. Either let the economic lifeline be systematically destroyed or pull precious air defense systems from the front to defend the rear, relieving pressure on Ukrainian forces. The deeper news is that to fund the massive war budget, the Russian government proposed raising VAT from 20 to 22% by 2026. This is expected to slow economic growth to 1% and push the deficit to 2.6%. Raising VAT is a classic scorched earth fiscal measure that will indiscriminately squeeze Russia's already fragile domestic consumer market. This shows that the internal cycle of selling energy to fund munitions production has hit its fiscal ceiling. The Russian economy is sliding irreversibly into stagflation, low growth, high inflation, and high deficits. The economic cost of war is finally being passed on to ordinary people on a large scale. Fifth key issue: Germany's structural marginalization and its strategic breakthrough in Africa. Markets generally view Germany as the EU's core driver with significant influence in the international multilateral system. But the latest news is that Germany was unexpectedly defeated by Portugal and Austria in the UN Security Council seat election. So what does this mean? In fact, this is a major diplomatic setback of great symbolic significance. As Europe's largest economy and a major UN budget contributor, Germany's defeat in the secret UN General Assembly vote profoundly exposes its structural decline and influence within the current multilateral system. Germany's recent economic stagnation, its return as the sick man of Europe, setbacks in energy transition, and its indecisive policy performance in the Russia-Ukraine conflict are severely undermining its diplomatic appeal among global South nations. The geopolitical influence of traditional EU core states is being marginalized. Caught between losing a Security Council seat and facing a potential 10% US tariff, Germany is urgently seeking a strategic breakthrough. Deepening ties with the Southern African Development Community aims to secure critical mineral resources and establish alternative supply chains free from US-China rivalry. Africa is gradually shifting from a pure resource exporter to Europe's last strategic hinterland for maintaining its industrial base. Sixth key issue: South Korea's counter-consensus political stability and a certainty premium from hedging risks. Earlier, markets widely feared rising conservative forces and potential political instability in South Korea. However, the latest local elections and parliamentary by-elections delivered a major counter-consensus result. Exit polls and vote counts show the ruling Liberal Democratic Party winning a landslide nationwide. President Lee Jae-myung has thus secured an extremely stable political mandate. So what does this mean? In my view, this victory completely breaks the previous pessimistic market expectations of political turmoil. With stronger control over local governments and parliament, Lee's pragmatic foreign policy will be strongly sustained. This means that while easing and strengthening South Korea's alliances with the US and Japan, it will not abandon economic cooperation with China. Meanwhile, his policy direction toward greater government transparency and boosting the stock market brings a significant certainty premium to South Korean macro assets, signaling that the won and Korean stocks will show strong resilience in a volatile Asian market.